Welcome to the Applied Blockchain Podcast, where blockchain technology and innovation are in the spotlight. My name is Ben-Ari, and I'm the founder and CEO of Applied Blockchain, and I'll be your host as we dive into relaxed conversations with industry experts and thought leaders to get their views on what they're building, the Web3 ecosystem and its transformative impact on the modern world. Andrew O'Neill, welcome to the Applied Blockchain Podcast.
Thank you for having me.
Andrew, please give us an introduction. Tell us a bit about yourself.
Sure. So I'm a risk guy. I'm really passionate about seeing innovation in financial markets that's done in a robust and risk-aware way. And the way in which I contribute to that, I work at S&P Global Ratings, where I lead digital assets and blockchain analytics. So looking at everything that touches on the use of blockchain technology and tokenization in financial market applications, as well as new types of on-chain assets and how they may be used and what risks they may bring into the risk analysis that we do. So for those maybe less familiar with S&P, we do risk analysis in bonds and fixed income markets more broadly, bonds and fixed income funds. And we're seeing a lot of that now coming on chain, the use for the technology in financial markets. And so we need to refine our own views and contribute our insights to the markets. I've been at S&P 15 years, initially as a securitization analyst. And gradually migrated through various roles in ratings before kind of finding my interest in this space. So I did some study in fintech back in 2019. Started gradually getting involved in some of our research projects in the area. Started chairing our research lab 3 years ago, and then took on a role full time in this space about a year ago now.
Right. Okay. Very interesting. What was your background? Like, what did you do before? What did you study?
I studied aerospace engineering and German. So I was always a bit technical, a bit of a geek, tendency to kind of get sucked into technical rabbit holes. So I guess that's how blockchain found me. So I really enjoy going down into the weeds of technical issues and trying to understand the risk from our perspective.
Okay, that's funny. When I applied for university, in the UCAS form you fill in, I think you have 5 options. So 2 were for aerospace engineering, 3 were for computer science.
Okay.
And it's just because there weren't many places that did aerospace engineering.
Right.
And then the ones I got into were computer science. So I almost ended up in the same, we could have met at university. So what was your, I guess when you finished that, did you go into finance?
I did, yes. Yeah. I did an internship in engineering, internship in banking. Yeah. Preferred banking. I did that for a little bit at JP Morgan in leverage finance. Learned a lot, worked a lot, and after that moved to S&P, where I kind of found a more long-term home for myself.
Okay, good. And securitization, I guess that's looking, obviously at all the different things that were being securitized and then traded.
I kind of view it as, I refer to it now as analog DeFi. So that was kind of my eureka moment when I kind of started getting interested in this space. Was everything that I looked at in structured finance and securitizations as an analyst, talking about transactions that are heavily codified in documents. The documents will set out for the 10, 20, 30-year life of a transaction, exactly who has to do what and when. When you think about what a smart contract does, it's effectively a technological evolution of that. Now, when we do document analysis in traditional securitization, sometimes we find gaps, we find unintended interpretations or unintended risks that get introduced, and we find maybe scenarios that haven't been contemplated when a document is written. When you're looking at smart contract analysis, it's a similar thing. So is the smart contract actually designed to do what it was intended to do? Has it been done kind of in a sufficiently clear way that there aren't kind of hidden risks, hidden attack vectors? So yeah, that similarity, when I first learned about smart contracts on Ethereum, that's really what pulled me into the space.
So you saw kind of coded rules for the product.
Exactly.
In the technology as opposed to pen on paper.
Exactly. So when you look at like a structured finance document, it will say, okay, $1 million comes in on Wednesday, and that has to be allocated to tranche A, tranche B, tranche C in this order. And it has to be done on this date. It has to not happen if some other condition has happened. So when you think about decentralized finance protocols, for example, you see a lot of parallels there conceptually in terms of what's being done.
It's interesting that you've been quite a long time at S&P, right? And I guess, again, I'm a technical guy, not a finance, but looking at it from the side, you were there for a period when the financial markets and securitization and also the complexity of products really grew almost exponentially and increased in complexity. And then we obviously had the financial crisis, which I guess you were kind of working at that time, right? And probably a lot of lessons learned from that as well. And then that's with one type of way of working and securitizing, as you said, a sort of analog. And then you look at the digital. What do you take away from all that? So what are the things that you think maybe weren't addressed and maybe needed fixing on the analog side? And then looking at the digital, what are the new risks that are introduced there? And what are some of the risks that are taken away, maybe some of those problems that you might have had analog that don't exist on the digital? How do they compare?
So as background, I was an intern at JP Morgan in the summer of 2007 when I'm working in the leveraged finance sector as well. When basically there were clouds gathering, but it was still very much full steam ahead. I went back for my last year at uni and came back then to JP Morgan in 2008. So I was actually on the training program in New York, walking past the Lehman Brothers office when that all happened. And so that was a very.
So you were really at the start of your.
Exactly. It was very much at the start of my career at the time, and that was, in a sense, a very educational time to be starting in financial markets. It wasn't great if you were looking forward to your first year bonus, but in terms of actually seeing risk materialize, I remember being in the better times as an intern, seeing some of the risks being flagged by our credit risk team. As a young analyst who drank the Kool-Aid of a particular credit, I felt quite skeptical of their interventions. Actually seeing that play out, seeing a financial crisis play out as a young analyst, I think is great experience. It doesn't always feel great at the time, but certainly you try to come out from it more knowledgeable and with an understanding that it's a tale as long as time, that exuberance will come in financial markets, pockets of risk will build up maybe where had not been anticipated previously. And one of the things that I really find promising about tokenization and blockchain technology is bringing additional transparency to markets, increasing the ability to monitor risks, but also increasing the speed at which entities are able to transact, reducing settlement times, reducing exposures to counterparty risks, and providing more clarity around the custody of assets. So when I look at that, I see promise in terms of risk reduction, promise in terms of operational benefits to entities, promise in terms of improving access to certain financial products, but there are also risks in terms of deploying that technology in a sufficiently robust way. When these things grow quite quickly, it's important to kind of have in mind what might happen if there is some technological failure, if there is some failure to perform by a very novel business. So we look at incorporating those risks then into our ratings, understanding how issuers have set themselves up to withstand those risks. I always like to come back to the fact that these risks do exist in the traditional world as well, and people have spent a long time thinking about them and mitigating them as best as possible. Tokenization can bring some benefit to that, but making sure that that's done in a way that can allow markets to perform smoothly.
Yeah. Okay, good. I've heard, I guess in various conversations, I've kind of heard different sides of that. So one is that, of course, through blockchains and tokenization, you can have more traceability of sort of what's behind an asset. I think one of the things that, again, as an outsider, looked like went wrong in 2008 was you kind of had things repackaged and sort of you could lose sight of the underlying risk. And so you can probably have that thread more verifiable and more and sort of more prominent in or present in a tokenization solution. Technically, it's possible. Of course, it has to be implemented, and it has to be implemented in the right way to actually get the benefit for it.
Yeah.
The other thing I hear sometimes, we talk about tokenization as a technology that can speed up certain processes, right? You talked about settlement, for example. I sometimes hear the other side of that, which is like markets are, one of the risks is that things move so quickly, right? And the other is when you put AI on top, then things are fully automated, moving quickly, and sort of exponentially doubling down on themselves, if you like. So that there's all of that, there's that risk as well. I mean, how do How does that sit with you?
I think that there's an interesting philosophical question from our standpoint, which is that in contexts where risk is becoming more observable in a real-time way, that's clearly the expectation on us as monitors of risks changes. So when companies are reporting their finances on, say, on a quarterly basis, that report comes out 6 weeks after the cutoff date, we'll take a couple of weeks to kind of triage the various reports coming in, and to the extent that something's happened, then take action accordingly. If we're moving more towards a world where some risks can be seen by the market build up in real time, then we need to be able to respond on that basis as well. Now, some of this is pretty far out, and so it won't be applicable to everything. I'm not expecting to see corporates making their financials available live in real time on chain. So I see more application in areas such as funds or securitizations, where there's the ability to monitor a portfolio of assets, and to monitor the composition of that, monitor the performance of assets, and with the proviso that for it to work, for that to be entirely operationalized from start to end, you need the underlying asset ultimately to be on chain. When you're talking about off-chain assets, then at some point you are breaking that chain of real-time data.
You've got a different set of risks that sort of sit behind whatever's before it comes on chain, basically.
Exactly. You need to understand what the on-chain risks or what the off-chain risks are. So we've just signed our first 2 ratings to tokenized money market funds in the last few weeks. So there, what we see is that the underlying assets are pools of short-term T-bills, U.S. government T-bills, and so there's a whole kind of off-chain structure around those that is very similar to what our funds analysts are looking at across their industry on a day-to-day basis. And then that's brought on chain. So there's some
you've got like the regular part of the business can handle that, and then
exactly. And so then that comes on chain. There's some platform that's being used to create tokens instead of issuing shares in the fund in a traditional way. Tokens get issued on one or more chains. So we need to think about the additional layer of operational risks and benefits that brings. We think about the smart contract that is creating those tokens or redeeming those tokens, whether there is any risk of that being attacked by some malevolent actor. Generally, that's mitigated through permissioned access, through the use of kind of fairly standardized and well-tested code on those smart contracts, and then with some degree of contingency planning behind that. So to the extent that there would be some problem with the platform or indeed with one of the blockchains on which tokens are issued, that the fund manager does have an ability to take mitigating action. Those are important contingencies to plan for, particularly in drafting documentation at the start. I think when we look at those funds, they're very interesting from a use case standpoint. So the 2 main investor groups that exist today are, one, stablecoin issuers who are looking to have more on-chain reserve assets. So to date, many stablecoins are backed by off-chain fiat T-bills. Being able to invest in funds that can manage those portfolios of T-bills to a kind of targeted maturity can be, one, operationally easier, but 2, also more transparent for investors. So there is a benefit there. And some of these money market funds also come with on-chain liquidity pools. So up to a certain amount, investors are able to kind of trade in and out of that fund for a stablecoin, and that has there's benefits for stablecoin issuers, but also has significant benefits for the second main group of investors, which are on-chain businesses, primarily the treasuries of decentralized autonomous organizations. So we recently saw the announcement by the MakerDAO, now Sky protocol, about the funds that they will be allocating investment to. We're seeing now the Arbitrum DAO go through a similar process, and the idea there is that they have on-chain revenues, they have on-chain expenses, they need to be able to manage liquidity with an asset that is liquid, safe, but ideally yielding as well. And that's what's been missing so far for that investor group to some extent, is that access to a safe yielding asset on-chain, and that's what the gap that some of these funds are looking to close. In time, you can see some promise in that technology also for corporate treasuries more generally.
This is what I was going to ask, because those two groups they're within the crypto ecosystem, right? They're kind of self-serving. Yeah, do you see this breaking out in any way?
Yes, I think so. When you look at the use case that that some of these crypto businesses have, they have the ability to automate, say, trading in between stablecoins and these tokenized funds to maintain a certain liquidity balance, and they can completely codify that and manage that within that narrow spectrum of low-risk assets. That seems quite an interesting prospect for a corporate treasury, particularly for a multinational corporate treasury where there's a lot of friction in moving liquidity across borders, costs, time, and stablecoins can help to oil those pipes, grease those pipes, and so having stable coins and tokenized investments can be helpful in that context. So corporate treasuries can certainly be one source of adoption, and that's part of the story why we're seeing more and more entities announce new stable coins. So we saw Fidelity last week announce the launch of a new tokenized fund. Yesterday they announced the launch of a stable coin. So you can see where these entities are going in terms of what the type of business they're targeting with these funds. What will be interesting to see over the next couple of years is how that then expands out on the risk spectrum. So today we're looking very much at money market funds. We're looking at transactions where with little to no credit risk. There's promise for this technology in other areas, such as private credit, for example, in structuring products that are more liquid, more transparent, and so we may see this spread out across the spectrum. Part of that will be driven, I guess one of the necessary steps for that to happen is investors getting comfortable with the technology.
Okay, there's a couple of questions I've got there. I mean, just to play that back though, I guess you've started with, like, in terms of entering this space, you've picked a few areas to focus on, right? Stablecoins is one of them, and you had the report, and you've got a framework for assessing those.
Yes.
Then you talked about the money market funds.
Yes.
Are there any other areas that you've sort of picked as in a...
So I think that there are a couple of areas. One is decentralized finance protocols, particularly in a lending context. Yeah. So we have a couple of our stablecoin stability assessments are on decentralized stablecoin issuers in order to kind of understand and monitor the risk of those stablecoins. You do need to get familiar with the underlying protocol and how kind of credit risk builds up in that. So that's one side. The other side that I think we're getting increasingly focused on is the emergence of I will say Bitcoin specifically as an investable asset within traditional financial markets, and the different contexts that we may see that asset used in. One of those contexts will be Bitcoin-backed lending, and looking at how to address risk in that context. Another will be various national and local governments holding a portion of their reserves in Bitcoin, maybe corporates as well. I think it's important to understand the nature of Bitcoin as an asset, that it is an asset that has no credit risk, very minimal operational risk for the asset itself, although the investor may have their own operational risks. But the key risk there is market value risk, short-term market value risk. And so when we look at use cases where Bitcoin's being brought into a short-term liquidity fund, that would seem to introduce risk. We generally don't see market value risk in those types of situations. When we're looking at a longer-term reserve portfolio, then it's a different consideration. But part of this is how we reflect it in our ratings, and part of it is also just helping to educate the market as to what this new asset is. It's something that for a long time many people may have simply dismissed or not spent a lot of time thinking about it, and now, whether you like it or not, you kind of have to have a view, and not having a view is having a view. Yeah. So if we can help market participants kind of focus on the correct risks from that perspective, then that will be I guess a good day in the office for us.
Okay, Andrew. So I guess let's go back to the corporate treasury, right? Because that's an interesting sort of case outside of the, let's say, the insular world of crypto and blockchain. So a corporate treasurer, you mentioned there's a potential use case there where they can switch between money market funds and stable coins, potentially manage their risk, their portfolio, and in particular for cross-border. payments. What would be, I kind of imagine corporate treasurers as being some of the most conservative and traditional in terms of thinking and just in terms of their approach to risk, right? Have you come across this, and what do you think the issues are that they would have to deal with in order to?
When you're talking about, let's say, widespread adoption beyond kind of specialist entities who are already actively in the blockchain space, you really need the kind of technical side of that to be abstracted away from the end investors, from the corporate treasury in particular. Possible that some corporate treasurers will enjoy taking on that new operational challenge themselves, but I think the base case would rather be entities that through their corporate treasury services provider, whether that's their existing provider or whether they end up switching to some new entity, that a lot of that complexity is abstracted away. So all they're looking at is a tool that allows them to manage liquidity in short-term, low-risk investments that marginally benefit their costs and bring some operational benefit to them. Yeah. I think when you're thinking about moving out on the risk spectrum, you're probably looking beyond most of the corporate treasury space and looking more into the kind of asset management world. So there was a very interesting case study done last year under the umbrella of Project Guardian by JP Morgan and Apollo. Where they were looking at use cases for the technology in portfolio management for asset managers. And so using tokenized assets as a starting point to build a portfolio, use smart contracts to rebalance that portfolio. The downstream impact of that is that some asset classes that are less easy for asset managers to allocate today, such as, for example, private credit, may become more easily investable because it is easier to invest a smaller portion of a portfolio into that asset class. It is easier to customize the portfolios of their end client investors and still include an allocation to those types of assets. So there are some interesting downstream impacts from that.
That's because of the infrastructure.
It's because of the infrastructure, yes. Because you may have many different types of assets, but all created on, say, ERC20 tokens or variants of ERC20 tokens. And so you can build automated portfolio management setups that can be helpful in that context. Yeah. When you start doing that, you need to start understanding, well, okay, what's the risk of the underlying technology?
That was going to be my next big question, really, because I guess the work prior to this would have been mainly looking at financial risk. The other types of risk you just described. Obviously, tokenization and blockchains. I guess some of the good stuff, the efficiency, and some of the risk being taken away are really being replaced by technology, and so that obviously then introduces technology risk. So how do you start looking at that, and how?
I think the conceptual point is that you're moving from trusting someone to trusting something.
Yes.
At the same time, you have an ability to monitor that thing that in some cases can bring comfort. I think the starting point will either be on something with an established track record of operating at scale, or on something where there is, I guess, an element of trust in some centralized entity, at least in the short term. Yeah. So, always start with the fact that the operational risk and the technological risk exists in traditional markets, and we occasionally see it materialize. Anyone in the UK will have seen issues with various banks and their retail banking platforms in the last couple of months that were very well publicized. These things happen, and when we look at financial market applications, we look at who is accountable ultimately to address an issue if it should arise. So when you're looking at something, say, issued on Ethereum, which is one of the more established and operationally resilient blockchains, we will be looking in transaction documents as to what transaction participants would do if there is some interruption, some unforeseen event. At the same time, although you are moving more towards the technology side rather than an intermediary side, there are still dependencies to be aware of within the Ethereum ecosystem. And so that introduces a requirement to monitor those dependencies on a continuous basis to understand, okay, where are there pockets of concentrated risk that are emerging? When we look at the track record, fairly strong decentralization of the network, some pockets of centralized risk.
This is what I was going to ask, because it's fairly complex. Look at this, obviously, from an applied blockchain perspective, we look at it from a technical lens, and we think about how secure is a network, so who are the validators, how are they incentivized, what's the consensus mechanism? Just probably just those three questions, if you took them across, many of the different blockchains that we see, you'll get very different answers, and that leads to very different risk, really. So there's a whole framework, I guess, if you like, that you could build here on top of technology risk specific to blockchains. Yes,
and then it gets more complicated because you often then see funds or stablecoins that are issued across multiple chains, and so the risk. But you need to look at the risk. The risk of the chains is different, but you need to look at the risk in the context of the transaction and what would happen if there was an issue on one chain. And generally, you see that certainly in the more robust structures, there are contingency plans that allow for, with backup of records, that allow for an investor to redeem on a different chain than the one they initially subscribed on if there was an issue. That's in extremis allow for redemption through a traditional bank wire, although that would kind of defeat the purpose of the transaction. It would certainly be a commercial defeat.
Yes. And bridges have their own set of risks.
Absolutely, and
they're scary.
And so when we look at any multi-chain architecture, we look at whether there is reliance on transferring assets across chains. So the two fund transactions, I should say, that we rated so far function rather through centralizing transfers at the fund manager level, so that you're not actually moving tokens from one chain to another. You're always moving back to the fund manager, and the fund manager then moves it back to the other chain. Similar in the more robust stablecoins, but absolutely, I think bridges are one significant issue. Another, when we look at particularly cyber risks in this space, initially looking in DeFi, a lot of cyber attacks were looking at attacking gaps in the code. That then moved to attacking bridges primarily, and so some of the largest attacks were done against bridges. Now that's moved a little bit towards targeting people and targeting people and wallets. So targeting ultimately the users within an institution. And so some of the more general cybersecurity practices that are implemented across organizations become particularly important in this space too. So we saw the Bybit hack a few weeks back, where attackers were able to basically get their withdrawals approved by that entity, and these kind of attack vectors need to be looked at then in any kind of tokenized setup that we look at. And so several things are generally undertaken. One is modularizing smart contracts and separating roles to kind of break out the potential vulnerabilities. That one role being compromised can only have a limited impact. Part of it is through controlling the access to a smart contract to whitelisted wallets, which also helps with AML and KYC obligations. But those elements of cyber resilience are really key. And when we bring that back then to the blockchain level, there's the validators, there's the clients those validators are running, there's the hosting providers that are hosting the actual machines, and you need to understand how those things continue to operate. We did a piece last summer when there was the CrowdStrike event that put out a lot of commercial technological applications in many different sectors. Ethereum kept ticking through, as did all the other major blockchains. And when you look at how you don't have that concentration or concentrated dependency on a single cloud provider, for example.
Okay.
So even if you have a number of validators that get put down because of some major issue with a single cloud provider, you still have enough of the network that keeps taking over to prevent any delays.
Yeah. Another one I keep coming back to is economic incentives in decentralization.
Yes.
Because if you've got somebody who says, well, I'm going to stop paying you all unless you do this, and that's another threat to the security of the network. There's so many different...
Yeah, and so when we think about the way that generally works is by the network automating that payment of incentives to validators in the network's native currency, which is why a native currency is needed, right? Because it is not something that's controlled by someone who's going to make a payment. Yeah. It is something that just gets created, so you don't have that risk of interrupting incentives. I think in Bitcoins, it's quite interesting because when you look at the incentives paid to Bitcoin miners, a lot of 90% of that comes from subsidies that are created through newly issued Bitcoin rather than from the actual transaction fees that are happening. And at some point that needs to change over the kind of long-term future of Bitcoin because those subsidies by design will trend to zero. And so for mining to remain a profitable activity, you do need to have, you do need to be able to be profitable on the basis of transaction fees alone. That's not a short-term issue. Those subsidies only get halved every 4 years, but it is an interesting thing to monitor in terms of the viability of Bitcoin mining.
Yeah, very good. Andrew, we ran a DeFi roundtable a couple of weeks ago that you joined, and it was super interesting. I think you were really probably the main contributor in terms of bringing really a huge amount of knowledge to the discussion. One of the things I brought there was quite related, a piece of work that we were engaged, that someone engaged us for around one of the protocols, the famous ones that blew up a few years ago, which was Terra Luna. And I keep citing this example because we were asked by a fund as a technology company to look at the smart contracts and assess the risks around the contracts and around really putting fund into the Terra Luna protocol, and also look at insurance options around that. And we produced a report, I think this was about 4 months before it blew up. We looked at the contracts, we looked at the data, and we could see which way it was heading. It was very obvious when you looked at those two things. And so the report did predict what eventually happened, and the fund didn't invest. But it just highlighted for me in black and white that the information is there. Investors were piling in, got to 8 billion or whatever it was. And clearly people were putting in very large sums without doing this level of technical due diligence. And we're not even going to all the levels of the blockchain itself and some of the things we've talked about. That was just the code and the data, right, which is completely out in the open. So it just highlights this huge gap in technical assessment of risks around the protocols themselves. Right?
Yeah, and I think on that specific example, there are a few issues in terms of how that protocol ultimately grew in the first place. And so when you look at how it was operating, maybe I'll focus first on the lens through which we look at these stablecoins. We started assessing stablecoins after that had happened, so it was more of a kind of backtesting case for us. But what that case study really showed was that it was a mechanism that relied on what we refer to euphemistically as endogenous collateral. So collateral that's created by the protocol itself, and they were promising to swap their stablecoin for $1 of this other token they were creating. So that worked for a while because they had market makers who were supportive of that mechanism, and it worked at a certain scale, but it was also scaling very quickly because of the very high yields that they were offering and that they were subsidizing. There were questions there that I won't get into around fraud, etc. There are cases pending on that. Also in terms of how that was marketed potentially to retail investors. But ultimately what was happening was that there was a very high yield on offer that was not actually being generated. It was subsidized, and the security of that price was maintained effectively by market makers. When that broke, the stablecoin broke. I think it's important to it's important as a case study to highlight the risk of innovation in this space, to highlight also that the rules of financial gravity still apply in this space. So, if there is no real underlying collateral, then it can be difficult to maintain a peg, for example. So when we look at stablecoins now, the only ones that we assess are backed fully by exogenous collateral, so collateral that's not itself related to the issuer of the stablecoin. We still see a spectrum of different risk levels across stablecoins, even on that basis, in terms of the quality of collateral, in terms of many other aspects. But that point about having that one-to-one peg to a fiat currency backed by actual collateral is critical in our view.
But for me, it highlighted the need for information to be available to investors, reliable information to be surfaced to investors about the protocol itself, how the risks and so on. Because again, the pure techies, we would be looking at this and saying, well, it's a fantastic protocol because it's got the contracts. This is how blockchain works. It's not going to do anything that isn't in the contract.
Yes.
And the contract's held up, right? It did actually work the way it's supposed to.
Technical perspective.
Exactly. Yes. So from a technical perspective, we'd say it's completely transparent. As an investor, you can look at the contracts, you can see what they're going to do. You can see the risks. The problem is that nobody looked, or those that looked maybe didn't have the tools to understand them. So for me, it just highlights the need for really having this information available that's reliably assessing and reflecting those risks to people so they can make their investment decisions as well.
I'd agree with that.
Very good, Andrew. Thank you very much. Very, very super interesting conversation. Just before we go, I always ask our guests to recommend some source of information. It could be anything, a book, a TV program, a Netflix series, whatever.
Okay, well, so I'll recommend a book I read recently called Smart Money by Brunella Rosa. It talks about the geopolitical implications of digital money more broadly, so CBDCs, central bank digital currencies, stablecoins, crypto, and what that means for the new world order. So where we've come from decades of a kind of international payment system that relies on effectively US dollar payment rails, blockchain technology now bringing new possibilities for new payment rails that may not be built off the US dollar, and what that means from a geopolitical perspective. So very interesting to understand the bigger picture of what's happening with digital money.
Okay, good. Adding it to my list. Very good. Andrew, once again, thank you very much.
Thank you very much for having me.